This is the Daily Market Rundown live from the Tradelo trading floor. It's September the 16th. Some highlights from today's show. The US dollar is now on the move. Tech stocks are up 60% since April, and US retail sales are now in view. Good day traders, and welcome. Happy Tuesday. Of course, it's been another slow start, but another very positive start as we head into the US session. And this has been an ongoing theme. If you were joining me last week, we've been talking about this concept of course, happy markets. Now, with that in mind, let's get across and talk straight away about what those happy markets look like, because it's not quite being reflected in Europe per se. Now, this isn't new. This was something we started seeing last week, which was this sort of divergence ultimately between what European equity markets are doing and US equity markets are doing. Now, this should be a little bit of a head scratcher, because we know that for most of this year, Europe, of course, has been the massive outperformer. Why? Well, because of all that wonderful fiscal stimulus that's coming down the pipeline. But for the past couple of weeks, we've started to see the US again begin the process of outperforming. Why? Well, because they've got some wonderful stimulus coming from the central bank in the next couple of hours. So that's the key takeaway, is that generally the US stocks are performing well as the Fed is about to begin the process of cutting again. And so a lot rests on ultimately what the Fed tells us on Wednesday. Do they cut? Do they cut aggressively? Do they tell us they're going to cut and wait? Do they tell us don't expect more cuts? We just don't know. We've got a set of obviously hypotheses that we'll go through when we do the daily market rundown tomorrow. But the key takeaway is that a lot of what happens in the coming weeks and months will very much depend on how the Fed updates and what their thinking is going forward. Now, with that in mind, it's going to be another positive session. There's nothing that's going to derail this, what's going on in the US equities. It is very much, blue skies up above. And until we get that update from the Fed tomorrow, it really is a case of either you stay out, but you don't want to fight this. Okay, you don't want to suddenly start providing liquidity on the short side, because ultimately, where do you place your stop? Where is the risk? Okay, best to wait for that Fed, and then ultimately, once we get that updated fundamental information, we can then of course consider what the landscape looks like based on the information. Okay, now with that in mind, in terms of some of the news flow, there was a lot. It's funny, you ask me if what was it like trading in 2011, 2012. We would never get this much news flow. There is so much news flow that comes on a daily basis, and it is of significance, which is why we have to deal with it. But I mean, again, just going through a few things. Of course, the S&P crossed above 6,600 for the first time. Record highs. It was the same for the Nasdaq, of course, and very much it's being driven by tech. Okay, I'll show you an interesting chart in a moment where we look at tech compared to, of course, the Russell, because there was a couple of weeks ago a little bit of a sort of a play or a sort of a narrative forming of moving over from tech into sort of the Russell, and I think the fact that that has stopped abruptly does tell us something very, very important. There's a real clue in that, the fact that ultimately the rotation play ended so abruptly. Okay, and we'll talk about that in a moment. But in terms of some of the other news, of course, Stephen Moran just got the nod. He only just scraped through with enough votes, which again, it really does suggest there are some within the Senate that ultimately do view this as a threat to Fed independence. Unfortunately, or fortunately, depending on which side of the spectrum you lean, he is now on the voting committee of the Federal Reserve, and he will, of course, be voting on the Wednesday meeting tomorrow. In terms of the federal court, ultimately they've blocked Trump's last-ditch effort to get rid of Lisa Cook. So she will be voting on Wednesday. She ultimately acts as if nothing has happened, and of course we know that will infuriate Trump. It's not to say that the case is over. She could still be fired, but now we of course will have hearings, we'll have information, etc., etc. Okay, so for now this will go quiet. This sort of theme of Fed independence will not necessarily escalate anytime soon, but just be aware of it. At some point there's going to be another attack on Fed independence, particularly if we do not get a Fed that is very committal on not just a cut tomorrow, but cuts at the upcoming meetings. Okay, if we see a somewhat hawkish Fed, don't be surprised to see again this idea of Fed independence being attacked start to form as a narrative. Okay. In terms of then what is driving the equity markets, what is driving everything higher, it is all pretty much AI stocks. It's all the tech stocks. It's the usual names we're used to. The Mag 7. Alphabet is now at 3 trillion. Nvidia is at 4 trillion. I mean, these were numbers. You go back 3-4 years ago, they were one $1 trillion company. Now they're all $1 trillion companies. What's changed in the last 3-4 years? Well, we've got this thing called AI. Is it justifiable or not? Who knows? But what we do know is there's a lot of money in the space. There's a lot of money that's very concentrated in the Mag 7. And we need to always be aware of that. Whether it's right or wrong is not so important. What's important is there is a concentrated positioning in a very small handful of stocks. And at some point that could prove to be problematic. Okay, and that's all you need to know. Will it prove problematic today? No, of course not. But at some point it could. And being aware of that concentration risk can obviously pay significant dividends at some point in the future. Okay, we know that Elon is now buying his own stock again. For some reason, that's positive for Tesla investors. They took the market up 3-4% yesterday. So again, not necessarily a negative when the CEO of a company is buying his own stock, but at a fundamental level, I mean, Tesla's not exactly doing well. We do know sales numbers are down significantly, order numbers are down significantly. General demand for electric cars are down significantly. Okay, what does this mean? Well, the market likes it. They like the fact that he's buying more of his own stock. Will this be sustained? I don't know. Okay, the point is that the market took it as a positive. And then, of course, CoreWeave now joins the party in renting chips from NVIDIA, or at least buying them from NVIDIA and then renting them back to NVIDIA. What does this all mean? Well, there's a general feeling that this is sort of a layering of pushing up each other's market valuations. At the end of the day, if there's capacity for it, if there's a need for additional capacity, data center capacity, then fine. The market is signaling to us that it needs it. Will this ultimately all blow up on itself? We just don't know. And I don't think having that sort of mindset is going to be useful. I think right now, just know that there very clearly is a demand for more data center capacity. We know that the Mag 7, the Big 7, are telling us they are willing to invest more and more capex each year into more capacity. Now, should that change? Should we be sitting here in a couple of weeks' time and we get some Q3 earnings and Microsoft comes out and says, hang on a sec, we don't think we're going to need as much capex spend next year? Well then, yeah, that's a massive red flag, and you can bet your bottom dollar we're going to get a 10 to 20% correction on that. All right, are we there yet? No. Okay, right now, the assumption we've got to make is the market needs the capacity. So again, in the same way that we want to be aware of concentration risks, we also need to be aware that there is a lot of spend on capacity right now, and we're not yet sure if the market needs it or not. We're not yet sure if there is the demand for it. Okay, that only time will tell. Right? No point trying to be an expert on this. You're never going to have sufficient understanding of whether or not there is sufficient demand or not. So just wait ultimately for those cues. Okay, the cue will come in a earnings guidance or in a capex revision down. That will be the cue. That will be the time to get very aggressively shorting of all markets. Okay. In terms of then China, they've come out and they are probing NVIDIA for anti-monopoly law violations linked to an acquisition that NVIDIA made back in 2020. The general thinking is there'll be a fine to the magnitude of around $1 billion, somewhere in that region. Again, is the monetary side of things a problem? Yeah, it's never nice to have a fine to that extent, but I think from a sentiment standpoint, this proves to be more problematic. Okay, in the same way that Europe, taxes a lot of the Mag 7 companies, and it infuriates Trump. This is the same thing. Okay, it's the same logic. They're going after one of the US's unicorns ultimately, and that's never going to be seen as a positive, particularly when there is quite a bit of nervousness, or at least sort of sensitive feelings with all the tariff situation going on. Okay, so this is something to keep an eye on. It's something that could perhaps maybe signal a little bit of irritation from Trump's side, where he does get a little bit more forceful. But what we've come to see, in particular over the last couple of days and weeks, is that Trump seems to have pulled back on a lot of his more aggressive rhetoric, whether it was towards Europe, Russia, China. He's not as aggressive at this point in time. Is it because he's now prepping for midterms? Is it because things are actually looking pretty good? who knows? Okay, the point is that right now he doesn't seem to be wanting to rustle any feathers. So we just need to be aware if that changes. Fine, we need to be switched on because that will create a little bit of vol in the markets. And don't forget, right now the markets are trading as if nothing can ever go wrong. Okay, so again, in the same way that there's a concentration risk, we also need to be aware of the fact that vol is very low. The markets are not concerned about anything. But if something was to come up, of course, that can all dramatically change in a heartbeat. Okay. Now, in terms of the currencies, I think this is where we're going to focus our attention and have a look at some of the charts. It's very much a bit of dollar weakness. That theme, of course, started on Friday. It's followed through yesterday and it's continued today. There is a general theme of dollar weakness as we head into this Fed meeting. And that's why, again, a lot of what happens next depends on the Fed. Okay. Do we get a hawkish cut? Do we get a dovish cut? Do we get a 50 basis point cut? Do we get a cut but a non-committal on the next meeting? The point is a lot of what ultimately comes next for the equities as well as the dollar will depend on the Fed. And it's the same for the currencies. Right now they are pushing alongside the rates markets. The general thinking is 3 cuts from the Fed at every meeting left for this year. And obviously the dollar is weakening on that. At the same time, and this is key to understand, there was a report in the Bloomberg now about the risks to the Bank of England being done cutting are very, very high. In other words, there is some expectation and thinking in the market now that the BOE won't be in a position to cut again, and the new neutral rate for the BOE is 4%. Okay, we'll talk a little bit about that over the coming days and weeks because neutral rates at 4% do pose a number of other problems, particularly for things like housing market. But the point is 4%. What that starts to open the door to is the idea that if the BOE is going to stay at 4%, and obviously the Fed's now going to begin a cutting cycle again, that creates a bit of rate divergence. Okay, and that's why we're seeing the pound break to new sort of almost yearly highs. We can see the euro almost touching on those new yearly highs as well. Okay, so we are starting to break out to 52-week highs in a number of the currency space against the dollar, and that is because the Fed's now about to resume a cutting cycle, whereas the ECB, the Bank of England, they're all ultimately done. Okay, that is the general thinking, and it's why the focus now does turn to euro and pound. Should we see a Fed that commits to cut at the next 3 meetings? Yes, that is going to open the door to a continuation of dollar weakness, and that is a rally for pound and euro to the upside. Okay, there is the euro chart. You can see it has now broken out of my wonderful pretty blue line. It's not the blue line that makes it break out. Like I said, it's the combination of what we've done prior to that blue line, as well as, of course, the market has been consolidating now for the last 2-3 months, waiting for something to move on. Okay, seemingly a dovish Fed that comes out with a dovish cut signals, intention to cut to the next 3 meetings and not be afraid to be more aggressive should the data warrant it. That will open the door to a breakout of that 118 level, a sustained breakout, and that does open the door for a move all the way up to 120, which is a very, very long-term sort of overhead trend line. It is one to watch an eye on, and we'll get there with relative ease should we see that dovish cut on Wednesday. Okay, but the key takeaway is that, and we will be talking a lot about this little play, the market now is getting very intentional on being bullish. We can see fresh longs are entering the market. They started that move on Friday. They've continued it today. So should we take out that Friday low? Okay, on a hawkish Fed, that is going to open up the euro to a retest of that 114. Okay, the point being, euro is in play now. It's in play either to the upside or to the downside, and all of that is going to depend ultimately on what the Fed tells us. Okay. The same for the pound. There we can see it. We're now breaking out to sort of almost that high made in June. And again, it does really open that door to a retest that 138. What you should notice, of course, is the pound is very much lagging the euro, and that's for good reason. Okay, the fundamentals in the UK are not very good. We are, of course, seeing European growth fundamentals being revised much, much higher, whereas the UK is very much a stagnating economy. Okay, so that is why we're seeing that outperformance in the euro. We have got all that fiscal spending coming down the pipeline in Europe, whereas in the UK they are really struggling at the moment just to get some sort of consolidation on their tax intake. So that's the key takeaway there. Like I said, we have broken above that 136 now, which does matter. We haven't closed above there since June. Ultimately, we can see that has been a reluctance area from buyers. They were not interested to take it above there. We closed above there yesterday. We've now continued that trend. Okay, again, in the same way that the euro is in play, both sides. should we get a hawkish Fed, all right, that pound is going to come back below that 136 and it's going to move very quickly back towards the downside, because there is that little bit of bullish pricing that new buyers have stepped into the market in recent days, and ultimately that is what would create that down move should we get that hawkish Fed. Okay, point is, it's another market in play. To the upside, to the downside, it all depends on the Fed. Okay, now there you have the Mag 7, the wonderful Mag 7, the Fang 7, whatever you want to call it, Mags, Fangs, they'll make up all sorts of names over the years. The point is that we're up 62% since April. Okay, that is the weekly chart, and as you can see, it can do no wrong. We've broken to new record highs. We're up 62%. These are not small names. These are, trillion-dollar companies that have just rallied 62% in the space of 3 months. Is that right? Is that wrong? Well, look, at a pure valuation perspective, it doesn't make sense. That sort of a amount of money entering such a concentrated space doesn't make sense from a risk standpoint. But hey, this is where we are. This is the lay of the land. And again, it doesn't matter what we think. It doesn't matter whether you're bullish, bearish. What matters is there's a concentration risk. And there are things that can derail that concentration risk or that rally and can create a nosebleed market sort of move that we saw very similar, of course, back in April. Okay, April markets were stretched. What came out? Well, it was a left curve, a tail event that came from ultimately the tariff situation, and all of a sudden we got a significant correction. Okay, point being, concentration risk exists. Right now, the Mag 7 can do no wrong. Now, if we compare that, and I think this is key, compare that to the Russell. Okay, what we can see is that Russell rarely is approaching those record highs, but it has been a large underperformer. Now, that wasn't always the case. The Russell was playing a little bit of catch up over the last couple of weeks. But what seems to have happened now is that sort of rotation trade has ended quite abruptly. And what's happened is there's almost a lack of interest to be back in the Russell, and all the interest has gone back into the Mag 7. Now, that should be a little bit of a head scratcher, because what created that rotation in the first place was this idea that the Fed was going to begin the process of cutting rates at just the right time. Okay, and when I say just the right time, it's at the time that it's going to support the growth narrative and ultimately support a reacceleration of growth. Okay, the fact that that rotation has stopped tells me as a trader that what's actually ongoing is that the odds of a recession are a lot higher. The odds of a low growth environment are a lot higher than ultimately, what the outright price of equity suggests. Okay, if ultimately Fed cuts were incoming and the economy was actually doing quite well or okay-ish, soft landing type scenario, Russell rotation would absolutely continue. Okay, it would be the star outperformer in that sort of a playbook trade. The point that it's not, the fact that it's not, does suggest that there is some concern. A slowdown is a concern. A recession odd is there. It does exist. And I think that's the key takeaway from what we're seeing in the Russell. Okay. Now, in terms of the calendar, what you can see, we're on Tuesday. Like I said last week, it's all about that part of the week. Wednesday, Thursday, Friday is where the action is at. As traders, we always want to make sure we allocate our capital accordingly. We don't want to get stuck in slow, grindy kind of markets. We really want to keep our energy and financial bullets till the key events of the week. What we do have out today, of course, we have got some retail sales. Will be interesting. Of course, we know retail sales can be volatile. We know that the consumer is not exactly, struggling in one sense, but they're not exactly thriving either. So it is going to be an interesting one. We do, of course, also have that US 20-year auction. Does it matter? Well, auctions were a topical conversation back in sort of May, June, when we were seeing concerns around the tariff situation. Less so now, because the auctions have been solid for the last couple of weeks. In terms of then some of the other key events, we've got Besant. He's currently talking, or was talking, about 20 minutes ago on CNBC, and ultimately he's going to be meeting with some of his Chinese counterparts, so we're going to hear a lot about TikTok and tariffs and all sorts of wonderful things there. Ultimately, President Trump is arriving in the United Kingdom. He's a big fan of the King, so he's probably going to go say hello to the King and spend some time with Keith Starmer. And so, yeah, there'll be some discussion topics there, but nothing really market moving, nothing to worry too much about. One thing that could be interesting as a general thought, and I've not read about this anywhere, but is don't forget, Trump is trying his best to ultimately get Europe to be a little bit more forceful against the Chinese in terms of the situation with Russia and sort of imposing some form of tariffs on China because they are demanding a lot of Russia's oil. And so don't be surprised if we got something agreed between the US and the UK. Okay, there seems to be a very good alliance. So don't forget, PM Starmer was first to agree to a deal with the US in terms of the tariff situation. They seem to be good buddies, and the UK is influential in Europe. Okay, so don't be surprised if there was some sort of a, hey, can you guys put a little bit more pressure on China to try and get Europe to also do something. Okay, something that could be of interest, so do keep an open mind as to that. But other than that, it's very much a state visit where the President of the United States will, of course, be whining and dining in the United Kingdom. Okay, with that in mind, don't forget, of course, there are a number of things out tomorrow, and I think that is, of course, the key focus point for the rest of the week. Okay. Now, with that in mind, if there are any other questions, do post them in the Discord channel. As always, like, subscribe, thank you, comments, those are all wonderful. Appreciate all the comments to date. If there are any other inquiries, do just let me know in the Discord channel. Otherwise, good luck out there, manage the risk, go make some money.